Welcome back to Real Estate Mindset. Happy Monday. Thank you for joining me to start your week. I have a great video for y'all today. Not only are we going to do our normal update with mortgage interest rates, real estate liquidity, which everything will be chaptered, we're also going to continue our training when it comes to mortgage rate pricing. So we're going to continue that training, and I'm also going to do additional training today on MLS. I'm also going to kind of break from a normal flow that we have here, and I'm going to talk about basically different reasons to buy. Now that we've kind of fast forward almost 2 years since I've been doing this, I want to talk about 4 different categories of buyers. And then I also want to talk about different market outcomes. I kind of want to talk about a little bit of a bullish narrative that I think is probably the most realistic expectation as far as that bullish side on what's going to happen next in the housing market. So I got so much planned for you guys. Wanted to give a quick shout out to my man Trey, who's on the screen. He says, hope there is some good news for buyers soon. Trey, I have some good news right now for you. Here's the good news, brother. Thank God, and at least you're aware. Okay, so being aware of the challenges is one thing. So thank God you're aware, and because you're aware, Trey, you've improved your situation. So that is good news. Also, the good news is we don't have these crazy bidding wars and appraisal gaps. There's quantitative tightening. But here's the bad news, Trey. The bad news is you got to be patient. We still got to be patient. Unfortunately, we don't have an all-out crash right now. There's not deals everywhere. We got to be patient. But thank God, Trey, you know what a good deal is. And in that, my friend, you're ahead of the pack. And that's good news for you. So anyways, guys, we're going to get started real quick. Just wanted to say good morning to everyone. Jeff, there's Christy, there's Les. Look at all these guys. Dean's here. Oh, my God. Johnny, it's here. Watch out for this guy. He's a great person, though. There's Cameron. My man, Mr. Watson's here as well. Really appreciate all you guys. There's I Am Blessed. I see you, Paul. I see Trey, the Robert Esquel, Florida Beach Bum. Appreciate all you guys. But we're going to get started right now. And real quick, guys, as I'm doing this video, I'm also waiting for a report to come out as well. Take a look real quick, you guys. So I did do a survey. I asked, and this is coming out today, the values of new homes, not existing homes, coming out today. I did a poll. 4.5 thousand people voted for it. 39% of people voted that home prices are going to go up. So this is going to update sometime during our stream. Personally, now I can tell you guys, I think it's going to go down. Normally it goes down from December to January. So I think it's going to go down, and it should go down a lot. If it doesn't go down, if this goes up once it updates today, in my mind, what that's going to mean is demand is back early this year. And then the question is our interest rates high enough, being that they're at 7%? So we're going to get into our mortgage update right now. Starting with the 10-year. Now, we've been tracking the 10-year pretty much this whole time. We know by now we don't track the federal funds rate. The federal funds rate hasn't moved in a while, but yet mortgage interest rates are moving. 10 years sitting at a balance right now, basically sideways, sitting at 4.26%. We've been elevated in the 4%. As long as we stay in the 4%, I thought we would be okay. But now I'm thinking maybe we need a higher 10-year. Maybe it's not high enough right now. Maybe it is, maybe it isn't. Let me know what you guys think. Do you guys think that 10-year and the mortgage interest rates are high enough right now? Because remember, we are in a pivotal moment. We are in a pivotal moment right now in the housing market, being that we are right in front of spring home buying season. That it is so important that during the spring home buying season that we have inventory growth. In order to have inventory growth, we need less demand than the already low inventory that we have. And that has been a challenge in the markets because people, the sentiment, not sediment, I'm not talking about sediment, sentiment is so powerful, it's strong. But take a look at mortgage interest rates, you guys. Here's the good news as well, Trey. We're still elevated. We're still at 7%. So the 7% is cooling off the market. The year started out, in some markets, and actually many markets, it started out hot this year. But now that we have elevated interest rates in the 7, it appears to be cooling down. We may start to see that in the data. But either way, you guys, we're barely over 7%. So if you can comment below, again, I'm really interested to hear what you guys have to say. Is 7% high enough? Is that high enough to calm down the obsession America has with purchasing a home? I don't know. I think it is, but again, it's just so hard to say because we're not in that spring home buying season. Once those two things clash, we'll have a lot better understanding. But you guys, interest rates are sitting at 6.08%. Let me show you how much interest that you guys pay. Now, I'm not trying to, bully you if you're buying right now. I'm not trying to say you're foolish. I'm not trying to do that. The reason I'm pulling up the amortization schedule that you guys see on the screen is to make you guys aware of how rich mortgage companies and servicers can get off of you paying 30-year mortgages. You guys, the interest you would pay back on the average loan of $324,000 at today's interest rate is a whopping $458,000 in fees. Okay. The reason I'm telling you that is I don't want you to pay it. You don't have to pay that. What you do is you attack your amortization schedule, which you guys see in the bottom left here. Now, if you look here, I've highlighted $305 to $145 because honestly, guys, that represents that basically you need $19,000. That's it. Only $19,000 down. In addition, I'm sorry, like after you close, you put $19,000 down on your amortization schedule, you save 5 years on your loan or $100,000 in interest. So the more that you guys take the amortization schedule seriously, the more that you guys will be winners, because remember, as you know, in a normal housing market, depending on your metro, as your equity goes up, your balance on your mortgage goes down. So you get like a lot faster equity growth. You get a lot more equity in your house a lot sooner, but you have to do both those things. You have to hope that you're in an area that goes up in value, but you also have to pay down that amortization schedule, and you will not do that making normal payments. It's kind of like, look at an amortization schedule, the monthly payments as the minimum credit card payment. So your payment on your mortgage is like a minimum credit card payment. You never pay it off. You're just making the bank happy. So I want you to look at it like that. You guys look at it like that, I think you're going to be in way better shape purchasing a house. So again, do that. You can also do extra payments. If you just pay just $200, just say $200 a month, okay? Extra per month. How much would you save over the life of the loan? $121,000. You guys pay an extra. You guys pay an extra. That's so crazy. And that's the good news, Trey. That's the good news. You pay an extra $200. You save almost 7 years and $121,000. So please, you guys, my point is knock that sucker out. Let's take a look at CME Fed Watch. CME Fed Watch is basically taking the market's expectation of what the Federal Reserve is going to do next. And I got to tell you guys, they are so wrong all the time. But let's see what the market is pricing in now. Here's also some good news, Trey. So the market is basically saying our next, potential rate cut or increase, or they do nothing, is going to be in March. They're saying 97.5%. The market is saying 97% chance, no rate hike in March. That's beautiful. Now take a look at May. May is also, this is getting better and better and better after the last couple of weeks. It did not start out the year good, but this is absolutely beautiful. This is probably the tightest it's been for May, sitting at 83.4%. So 83.4% chance, you guys, basically that is going to stay elevated in May. But take a look at June. Okay, June also good. 35% chance of no rate hike in June. July, we're sitting at high. Man, this is crazy. So July is now sitting at 15% likelihood that we remain elevated. And I'm going to tell you guys, if demand does come back this year, these rates are going to stay high. If the housing market rebounds again this year, these rates will stay high. Look at the end of the year. Here's what's important. Okay, so let's see here. So the market's basically now pricing in 3 rate cuts. Remember, it was like 3 to 4 rate cuts. Now it's straight up 3 rate cuts. You guys see that right here. So they're saying 3 rate cuts, total rate cuts being 75 basis points. So that's what's going on in the mortgage update, guys. Let me now go to show you something else. What I want to do now, guys, is I want to show you. I'm going to go back here instead of going to that video real quick. Okay. What I'm going to do is I'm going to show you guys, how mortgage rates work if you're a consumer, okay? Or even if you're a loan officer. This is going to be a good part of the video for you because we're going to do our pricing update, okay? I'm going to do a timestamp right on our pricing update because, again, you guys as consumers need to know how this works because this is how lenders make money off of your mortgage interest rate. Now, you guys know that we have been doing some training on interest rates, and I have told you guys, don't call it, just for the sake of our training, don't call them interest rates, okay? Call it pricing. Because it's the pricing or the cost of the interest rate that changes every single day. It's not really the interest rate. So as a consumer that wants to buy a house, wants to get a mortgage, you guys have to understand how that pricing works because not only do you want to make sure you're getting a good deal, you're not being taken advantage of, but you can also work on things like credit, down payment to get an even better rate. So let me pull this up for you guys right now. Here's how I'm going to do this, okay? All right, I got to explain this to you first, okay? So just bear with me. This is going to be very easy. I've added something to our lesson to kind of just take us to the next step. Now, Obviously, this is a pricing sheet, okay, or a rate sheet. So that's our rate sheet in the middle, okay? Now on the left side, okay, so this side is our scenario, right? This is our loan amount right here. Here's our credit score. Here's our down payment. And here's the interest rate we want, okay? Now, here's what I added, you guys. I added to this form adjustments. That's it. That's the only thing I'm adding today. I'm just putting adjustments on the same form. So your right side is your adjustments, because remember, there are pricing adjustments depending on your credit score, down payment, debt to income ratio, state, property type, all these things, right? But what I wanted to show you guys is the adjustments for credit. You see that? And the adjustments for down payment. Okay, so just stay with me for a second. If we look at the credit section real quick, you're going to see that if you have a credit score of 680, your pricing is going to increase by 0.25 basis points. If you have a 700, because it goes in tiers of 20, so the pricing adjustments for credit score go in tiers of 20. So 600, 620, 640, 660, 680, 700. Okay, now if you have a 700 credit score, you have a hit to your pricing, so a penalty of 0.15. All right, so you guys can see already, if you have a 700 credit score, it's less expensive. But if you have good credit score and you now have a 720, you get to reduce the pricing by 0.15. So 680 is a hit, 700 is a hit, but if you have a 720, you get rewarded. Now, same thing with the down payment. You guys can see at a 5% down payment, the fee is 0.25 hit to your pricing. And if you have a 10% down, you get no hit. Okay, that's all I'm going to do. I don't want to overwhelm you guys. Now, let's go back to the left side. Look at our loan amount. Okay, it's 200. Our credit score is 720. Our down payment is 10%. So when I go over to the pricing adjustments, look it. I go to the 720. Look it. I get rewarded. The pricing is negative 0.15, which means I get a credit. So I'm going to put negative right here. You guys see what I'm doing? 0.15. Now, I also have a 10% down payment. So go over to the pricing adjustments. Look, there's no pricing adjustment for a 10% down payment, which means because I have a 720 credit score and I have a down payment, that means my pricing will get better, not worse. Now, if I had a 680 credit score, my pricing would be worse. Okay, so now what we do is we look at the 4.25, because that's what I want. Okay, so I want to lock for 30 days. So here is the 4.25 right here. Now, this is an old rate sheet. Everyone would be jumping on top of a 4.25 right now. You cannot get this. This is an old rate sheet. But what this represents, you guys, is if I take a 4.25, remember when it's in parentheses like that, I get a rebate. The bank pays me money to take that 4.25. Do you see that? Okay. So in order to understand what the total cost is, I got to take that 0.399 and put it over here. So I take, let's see, 0.399. And remember, that's a rebate. Okay. And because I have to subtract here, I actually add this 0.19. I add this right here to that because it's already a rebate. Okay. So what does that equal, guys? Do y'all know what that equals? What is that? Darn it. 0.54. Is that right? Okay. So the final price here, I'm sorry, I'm doing this in my head, is 0.54 rebate. Okay. Does that make sense? Hopefully that makes sense to you guys because I got notes all over the place. Okay, so now what we do is we take the loan amount, all right? Let me make sure I could show you guys this real quick. Let me see if I could do it like this. Boom. You guys see the calculator right there? You should see the calculator in the middle, okay? So I'm taking the loan amount of 200,000 now, and I'm going to multiply that by 0.054, hit enter. Okay, actually, I 0.0054. But what this equals is, this means, you guys, okay, this means that the pricing is, I get a rebate of plus $1,080. Sorry. Okay. Now, it probably look confusing. I'm looking at the notes now, and I'm like, God, this looks so, I'm so sorry, guys. You guys are probably like, what the hell? If you just logged on right now, just rewatch this video, like, oh my God, that looks so confusing. But the thing is, guys, is that's how mortgage rates work. That's the main thing I'm trying to tell you guys. Hopefully that made sense to you. So what I did is, again, it's not about mortgage rates don't change every day. It's the pricing that changes every day. So I want you guys to understand that. And also there are adjustments and hits to the pricing based on credit, based on down payment. And also I want you guys to remember is generally, not all the time, but generally a broker is going to beat a direct lender. Generally a broker will get a lower rate than a direct lender. It's just how it is, you guys. Now, what I'm going to do is let's move on to our first video real quick. And the first video is just going to be, you guys are going to be mad at me for this first video probably. The first video is going to be about basically where home prices are going to go. It's going to be a bullish perspective on home prices. I think it's important for us to just cover many different bases here, but here's our first video, you guys, right now. Don't forget to comment below. I'll be answering your comments here towards the end, but let's take a listen to our first video from Fox News.
The home builder sentiment, it rose to the highest level since August 2023. NAHB CEO Jim Tobin joins me now. Mortgage rates are ticking up. I saw them just at 7.09% on the 30-year fixed. That's not good news for you guys, is it?
No, we need mortgage rates to continue to fall. Right? We're off our highs, which is good. We saw them over the late fall, so good news there. And that obviously our builder sentiment has reflected those lower interest rates and people starting to come back and at least get into the market. But it's going to be an uneven ride between now and what is ultimately the recovery and where interest rates settle down, we think, in 2025. So not surprising we're going to see this, but we expect them to start settling back down soon.
Home prices really started to take off, I think it was in 2020, and they went right straight up since then. And now people are calling this a housing bubble. Is it a bubble?
I don't see it's a bubble. I think that people are trying to take the lessons from the 2008 crash and bring them forward almost 20 years. And I just don't see that happening. What we are facing is a crisis kind of our own making. Coming out of the Great Recession, builders were apprehensive to get back in the market in a big way, fearful of putting too much supply in the market and regenerating that big boom market that we had in the 2000s. So underbuilt for supply. And then once we started to bring back our supply, we ran into headwinds with land use policies being very restrictive, lot prices, persistent labor shortages. Then we ran into supply chain issues. That's why housing is going to continue to stay high for a while. And the only way out of it is to build more housing.
There's a great deal of money being made in the stock market. Sometimes that transfers over to the real estate market. I know an awful lot of people who are waiting for the housing bubble to burst so they can use their capital from the market to jump in there. But you're telling me they're not going to burst. The bubble doesn't burst. Prices don't come down.
No, I think if investment's going to flow into housing because there's money to be made in more supply, not because of a crash or a crisis. That's what I think is going to happen here. I think when rates settle down, there's going to be an opportunity for people to get in. We're hopeful it's home buyers. Speculation tends to drive the froth in that market, but we're always going to have that. The main thing is let's get housing affordable so more Americans can get into home ownership.
But I take it you are seeing quite a few people who've made money in the stock market using that money to get into the real estate market, often buying full cash, high-end stuff.
That's really been the big issue. We're in the high-cost markets where you can sell a house in New York or New Jersey and move south into the Carolinas or Florida. They're paying cash, and they're driving up the cost of housing. Sure, that happens in a lot of markets.
One question I ask you guys frequently, what's the average size of homes being built today? Because 10 years ago, they were getting bigger and bigger and bigger. But then I think the trend reversed and they get a little bit smaller. Is that smaller trend still in place?
Smaller homes still in place. We were about 2,300 square feet were the average. We're now closer to 2,100. And that is a symptom of a smaller house costs less, making it more affordable. People are shrinking their desired footprint so they can afford the home that they want.
The 2,100 square feet. Yeah. I'm trying to imagine what that looks like. That's 2 bedrooms, 2 bathrooms.
Probably 3 bedrooms. Yeah, that's right. A couple 2.5 baths. Yeah, garage. Sure. I mean,
it's come down to that.
Yeah, that's right.
There's no more bonus rooms. Remember that?
Well, that was actually a symptom of COVID. People wanted gyms. They wanted home offices. So there is still a trend for a bonus room, or at least that conversion of a bedroom into a place where they can work or work out in post-COVID. Yeah. That's still out there.
Why are you laughing? Bonus room.
Because it's a very nice place to be where you can have a bonus room.
I always said I will never buy a house which is advertised as having a bonus room.
Oh, really?
Because that's a room you don't know what to do with, right?
It's a place for your stuff.
Yeah, your stuff.
Or your gym.
Jim, always good to see you.
Thank you,
Thank you very much.
I told you guys. I try to warn you, okay? That was brutal. I mean, the thing is just say that home prices aren't going to go down. They as your bullish just say it's going to stabilize. But when people say the bubble, like there's no bubble, like how the heck can you say that? And I'll show you guys what I believe the bubble looks like. But what I want to do now is I want to move on to a different portion of this video that I was kind of brainstorming, and I kind of wanted just to revamp. And I wanted to talk to you guys basically about different reasons to buy, different levels of buying. And I want every single person to understand that buying a house is a personalized decision, and your situation is greatly, greatly different than other people's situation. Your market is greatly different than my market, unless you're in my market, obviously, right? But my point is, guys, is like, there is no uniform answer here to affordability. But I will also say that generally affordability starts with you. Generally, it starts with you. Okay, now obviously the Fed messed that up, inflation messed that up, these institutional investors, mom and pop, all these people messed it up for us. But generally, it starts with you. So I wanted to acknowledge that. I want you guys to understand that. Okay, I'm trying to be as balanced. What I'm saying is I'm trying to be as balanced as possible because I understand there's different reasons to buy. But nevertheless, you guys, I still feel like from a price standpoint, possibly not a systemic standpoint, I think prices are going to go down more than they did during the GFC. I do not think we're in recovery mode. So I want to make that clear. But just because I believe that prices will go down, continuously go down, doesn't mean you're not necessarily safe. That's my point. You have to weather the storm if you're going to buy right now, which is very, very toxic. So 4 different buyers. Okay. The first buyer are the well-off buyers that don't give a crap. Okay. There's a substantial amount of those people buying right now. I would say a great deal of the buyers right now are well-qualified buyers. They just don't care. And when we look at that, those are the people that you can argue that are messing things up for locals, because a predominant amount of those people, a lot of those people, not all, a lot of those people are migrating. And the migration, especially into cities like Boise, it messes it up. I mean, this big migration into small cities, it's haywire. So migration is going on right now, you guys, and that's drastically affecting some housing markets. So I just want to acknowledge there are buyers out there, and some of those well-qualified buyers that don't care, maybe they'll be fine through recession. Maybe they have $1 million saved and they don't care, and that's why they don't care. So is it wrong for them to buy? Maybe not. Maybe it's hurting us as the natives that want price correction. But does that mean it's not okay for them to buy? It doesn't mean that. If they want to overpay, if they don't feel like they're overpaying, then so be it. If they can weather a storm, they don't worry about unemployment, then so be it. Buy and enjoy your life, right? But I also will say I'm talking about primary residence. Investing right now in real estate is an entirely different subject. So you have that. But you also have the second buyer, the well-qualified buyer that's waiting. And those are most of the people I feel like that are following our channel, that are in our Discord community. I feel like most of us are well-qualified buyers, but we're being patient. And that's why in the beginning of this, I said, Trey, that, the bad news is the patience. The good news is that you're aware. And because you're aware, you're now empowering. Because you're empowering, you're now getting good at understanding real estate. And because you're good at understanding real estate, you're getting better. You're safer, Trey. You're safer, Trey. It's hard right now. Things are we took an escalator up, but we're taking a staircase down. And that patience sucks. And the reason why the patience sucks, Trey, is because we don't know what's going to happen next. Why? Because the Federal Reserve cannot tell the truth. Think about it. They cannot tell the truth. If they told the truth about what was really going on in the background, we would have a crash tonight. But it's confusing. And it's really, really messed up. But anyways, so that second level of well-qualified buyer, basically what we're going through right now, you guys, is patience. But I'm going to tell you guys this. Remember what I'm saying. I have been looking to buy a house for 2 years. I have made offers every single year. I may make an offer on a house this year, but I am not buying foolishly. I'm using fundamentals. I'm saying, okay, I have the right expectations. I have no consumer debt. My payment is about 25-30% of my take-home income. I have money saved, and I know what a great deal is, right? So when I find a great deal, I can get it. And that's where Trey's at. And that's where Jeff was at. That's where Johnny's at. And I'm going to tell you guys about Jeff Amma. We've had multiple people in our community purchase houses. Even though I'm warning you guys, we've had multiple people purchase houses in our Discord community. But the thing that I always want everyone to remember, especially if you bought a house in the last 2 years and you got a great deal, be a light. Don't be dark. Be a light. Explain to people how you got that great deal, like House Hacker, like Jeff. Jeff got a great deal because Jeff was patient. And he used skills to buy a house. You guys can do that too. He used a love letter. And I don't remember, Jeff, how much you got off, but he got $40,000, $50,000 off his house, and he was patient. So, you know, you can find deals that work for you. It's just very, 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 very hard right now. It's very, very hard. And in some metro areas, it may be a little bit impossible right now, but there is hope, you guys. My point is there's hope. It's just the patience. Get over your lack of patience, right? Now, there's a third buyer. Okay, now this third buyer is also hurting people. The third buyer is the person that doesn't give a crap, that is barely able to qualify. Now, prior to the home values going up, most buyers were barely able to qualify and didn't give a crap. Most consumers were like that. And so right now, if you're just buying a house, you're a consumer that doesn't give a crap. You know, if let me take that back. If you're buying a house but refusing to use fundamentals to purchase, then you're buying a little bit like a normal consumer that doesn't care. You can choose to buy a house as your primary residence that doesn't have fundamentals like cash and wedge flow, but understand, hey, that doesn't have fundamentals like cash and wedge flow, and I'm okay with that. Don't keep your head in the sand is what I'm saying, but there is that third buyer barely qualifying. And I'm going to tell you guys, things have got more unaffordable in a lot of metro areas. So that box of people on the sideline, I mean, it's getting bigger and bigger and bigger. Now, that brings me to the fourth buyer, locked out. There's a great deal of buyers that are locked out right now that would purchase a house if they could afford it. So to those buyers, they probably feel helpless. You know, the buyers I just talked about, the barely qualified buyers, those are desperate. The ones that are locked out, helpless. But the great news, Trey, and anyone that's listening is that doesn't have to be that way. And things are changing. Quantitative tightening is changing. And each and every one of us can empower ourselves. And the more that we empower ourselves, the closer to affordability that we get. The more that we use fundamentals, the more that we are empowering ourselves, the closer we will get to unaffordability. Can we say that it's going to come back to every metro area? No way. No way. Hollywood, California, New York, I can't live there. That will never be affordable to me. And that's what I'm really trying to tell you guys. Now, let's talk about outcomes of the market. And I'm almost done ranting. Hopefully you guys don't think I'm ranting. I'm almost done with this segment, but let's talk about the outcomes of the market. Now, I have been saying since the beginning, explaining my definition of a minimum crash being 15%. But now I'm thinking, you guys, I've been thinking a lot about this. I'm like, you guys, we have 15% decline in multiple areas. Why is like no one talking about this? I think I may have to change my definition of a crash. And I based 15%, talking about prices, not systematic failure. I based on 15%. And I did that because when we look at the GFC, the average loss of house was 19. So I was like, okay, biggest crisis of my life, 19. So the start is 15. But the thing is, we already have that loss. We have that in areas. So why is no one feeling that? Why, unless you bought a house, if you bought a house recently, you feel that. But the thing is, here's the problem. Here's what I'm facing. Here's what I'm seeing. Here's what I'm noticing. 15%, people don't feel it. We're already down 50%. People don't care. People don't care about 15%. People don't care about 15% because houses went up 40% in 2 years. If houses went up 40% in 10 years, people wouldn't care. But houses went up 40% in 2 years. And so people don't feel the 15%. Isn't that, think about what I'm saying. 19% ruined us last time. Right now, we have areas of 15%. People can't even feel it unless they're recent owners. And that's why I constantly direct you guys' attention to these buyer remorse surveys, because those buyer remorse surveys is telling us that they regret that decision to purchase. And then we look at why did they regret? Because they rushed the process, because it's unaffordable. They shouldn't have done it. Now they're trapped. They can't sell. They can't refinance. They're locked in. So I think it's important, man. I mean, I may change that. I've been saying that from the beginning. I may up it. I really want to think about this. We haven't had a national 15%. We went to almost 14%. But anyways, guys, now I also want to talk about like the other side of the coin, the more bullish narrative, like prices aren't going to go down. And I was talking to, in our Discord community, I was talking to Jeff and also a couple of people in our Discord community. And I was like, the one bullish narrative, and it's not even that bullish, but the one bullish narrative it kind of makes sense, because most of it is just emotion. They're just going to bail us out, just buy a house. I don't even want to listen to it. But the one that I am watching, because it happened during the 70s and 80s, and I have a chart, and I'm going to show you guys in a minute, that the housing market stays sideways, say for 5, 6, 7 years, but wages catch up to equity growth. And in that sense, that is a type of crash, but it is not deflation. It's basically disinflation. So the concept there is we have disinflation, which we haven't had, by the way, but we have in some markets, but we have disinflation long enough, sideways housing market long enough to where the entire US catches up with wage growth. So we all make 60% more in 6 years from now. Do y'all think that we're going to make maybe like 50, 60% more in the next 6 years? So that is the bullish narrative that it makes sense to me. And a lot of people, Jeff compares the 70s and 80s. So when we get to that segment, the liquidity segment of this video, I'll show you guys why I don't believe it's going to go down like that. And quite frankly, I'll tell you guys right now, the consumer is not in the same shape as the 70s and 80s. When we compare like the consumer's ability, purchasing power, ability to save, the affordability, it's nowhere near the same. And I'll show you that by comparing, and we'll look at CPI to compare that. So I'll throw CPI over Case-Shiller home value, and I'll show you guys 70s and 80s, not even, in my opinion, right? And this is just my opinion, and I want to be careful with my opinion. I want to report to you guys what I see in the facts, but it is what it is. We're going to go into a video right now, you guys, and then after this video, we're going to do our MLS education for this video series, and we're going to listen to Danielle DiMartino. I love listening to her. She's going to talk about the Fed minutes and how the Fed is acting hawkish. Too bad they didn't do that the whole time. You know what I mean? Like, too bad they weren't hawkish the whole time. Like, golly, guys, I feel like they messed up so many times. But anyways, we're going to move on to that video. If you guys can, please let me know that the audio is okay.
And QI Research CEO and Chief Strategist Danielle DiMartino booth. So the market's moving down a little bit on this sort of, you know, the idea of cutting too quickly. What are your thoughts on these minutes?
Well, the minutes were certainly, I think, hawkish all the way around, Charles. Only a few, quote unquote. And you always have to be cognizant of how many people the minutes allude to, whether it's many or several. But only a few of the participants were apparently worried about cutting rates too slowly. So in other words, most people want to wait and see. And to Edward's last point that he was just talking about reducing the pace of quantitative tightening, reducing the pace at which the Federal Reserve is shrinking its balance sheet, there was language added that said, we are going to talk about this in depth in March as to the eventual is the big takeaway, eventual decision to start shrinking the balance sheet. Eventual can be a mighty long time when transitory can last for years, Charles.
I was just going to say that we have to rewrite the financial dictionary. You know, one thing I've been reading about here is this reverse repo program running out of money. We've got it on. We're going to put a chart up here in a moment. So it was about it was $2.5 trillion. It's down to less than 500 billion. But it is declining rapidly. And everyone's saying when that happens, Katie Bar-to-door, all hell's going to break loose. What are your thoughts?
Well, you know, I think most Fed officials target ample regimes when they can quit shrinking the balance sheet at about 10% of U.S. economic output, 10% of U.S. GDP. So call that $2.7 trillion. So the reserves in the system have actually increased, Charles, since the Fed started tightening policy in mid-2022. You've got about $3.5 trillion in bank reserves. So that means that even after you run down this final $500 billion in the reverse repo facility, there's still at least $900 billion worth of quantitative tightening that most Fed officials see as being appropriate before they have to stop. Now, the reverse repo facility being depleted means that every billion of Fed balance shrinkage is going to be felt more in the financial system. It'll feel tighter.
Right. I mean, I thought that was the goal in the first place. I want to ask you about this sort of anecdotal stuff we see almost every day. The layoff announcements, they keep mounting. Car prices are imploding. Now, I know that it's supposed to be good news because that means the Fed is going to force the Fed's hand and they start cutting. But when is it too bad to be good? In other words, when will bad news be so bad that the markets reflect it?
Well, I think the bad news is going to have to be bad in the official data. We just got out data that showed that job growth was appreciably lower than what the Bureau of Labor Statistics originally reported. Great big surprise. This was out today. We're going to have to wait a few months to see what those actual numbers were, but wage gains were a lot lower is the point. Trueflation, we just ran a fresh correlation since March of 2022 when we knew that tightening was imminent. 0.99, almost perfect correlation with headline CPI. That's at 1.61%, Charles, today. That's what, half, less than half of what official CPI is? My point, Charles, is the market's going to be waiting a mighty long time if you're waiting for this administration to actually reflect reality in the official data. And that's what Jay Powell's referencing to stay higher for longer.
All right, so we're back to higher for longer. Wow, it's like a ping pong game, right? But it is what it is, Danielle, and that's why we ask you to come and straighten us out, because there's so many there's so many conflicting signals and signs and commentary. I trust you the most. Thank you very much.
Big shout out to her. I mean, she is so good, man. Hopefully I'll do another, excuse me, hopefully I'll do another interview. Now I'm going to go into the MLS real quick, but I wanted an opportunity to talk about this comment right here. It's actually really good. It brings me to a segue into what's actually happened in the last 2 years. Now, first of all, let me read this real quick. You have been saying this. Hold on. You have been saying the same thing for I'm just kidding. For over 3 years, nothing has changed. Most of the markets have seen prices rise. So why? I mean, dude, like, it's okay if you want to make a point, but don't, lie to people. Don't deceive yourself. I mean, I haven't even been doing this for 2 years yet. My 2-year anniversary is in about a week. So I've been doing this 2 years, buddy. And also let's, are you paying attention? Are you paying attention? Let's ask what has happened in the last 2 years. Okay, first thing, we started quantitative tightening. So I've been doing this almost 2 years. What has happened in 2 years? Quantitative tightening, hello? Ever hear it? Yield curve inversion. That happened, 2-3 months after I started this? Yield curve inversion happened. Hello, Earth to you. And then what's another thing? 100 years since this has happened. 100 years. What has happened in the last 2 years? 100 years. M2 money supply went down. We've had bank runs for the first time in 100 years. I mean, come on, man. Okay, we have several metro areas with actually price decline. Are you paying attention? We had prices of houses go down for the first time since the GFC in middle to end of 2022. If you're not paying attention, don't comment. Or comment. If you're not paying attention, comment. I mean, but don't be petty. If you're petty, you're just going to stay a sheep. Don't be a sheep. I appreciate you, though, for sure. I appreciate you commenting because it really allows me to strengthen myself. Now, let's do the MLS portion of this video, and I'm going to show you guys. We're going to be doing this based on a foreclosure. If you followed me on Friday, and we did a live on Friday, you guys will probably remember a property that I found that was like super low. I was like, anyone that wants to buy this, hit me up. I'll rep you. So we're actually going to do a market analysis on that right now because I could tell you guys it does have wedge. I could just tell by the numbers, but I'm going to do this in a different way. Okay. I'm going to do this in a little bit more specific way because I want to impact. I already know this. I want you guys to know this. So that's what I'm going to do. Now, dang it, I'm probably going to have to do this again. Now, first of all, I'm going to pull up a map. I want to show you guys something real quick that I think is going to be helpful at understanding exactly why I'm showing you what I'm showing you. Okay. And what I'm going to do is I'm going to pull up this map right here. Okay. Now, understand what I'm saying here. Okay. If you want to know if you're going to get a good deal, it's simple math, you guys. You don't have to pay $10,000 to join some cult. I mean, join some real estate club for $10,000. Are you kidding me? This is simple first grade math. But you have to understand how to do the math. So what you guys are looking at right now is you're looking at the metro area of, anyone want to guess? Kingwood. You guys starting to understand why I kept us in Kingwood for so long? Because we can monitor this whole thing. So what you guys are looking at is Kingwood. Kingwood is local, right? Kingwood is a local market. So for example, Kingwood, let me just put this up here. So Kingwood overall in 2022, okay, we're just going to say over the last year, the average price per square foot hypothetically is $140. Okay, can you guys see that? Okay, jeez, I don't feel like you could see that well. But anyways, so $140 price per square foot in Kingwood. But remember, you guys, we got to go even more local. If I go to Redfin and I pull up Kingwood, I don't know what's going on. I have some general consensus, but we got to go dig deep. We got to access MLS. So when I access MLS, I can find out Kingwood sold for an average $140 a square foot over the last year. But remember, we got to go to subdivision. Here's a 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 subdivision. So if I'm an agent, okay, so realtors pay attention here, and I work Kingwood area, I'm going to know that in this subdivision, the average price per square foot was $150. Okay. I'm going to know that in this subdivision, average price per square foot is $130. In this one is $120. This one's $140. This one's $145. Every subdivision is different. If you are an agent, you should know each subdivision and how much the average home sold for over the past year, and then compare that to 2022, 2021, and 2020. And what I do personally to determine whether or not, like, a baseline case for, is someone getting an okay deal? Is this a great deal? Is I base the numbers off of 2021, because in 2020 and 2021, that's where we had radical price growth, and then it started kind of slowing. But I like to go off of 2021. So I'll compare what things were selling for based on 2021. So do you guys see how this works? It's so simple. The problem for consumers is y'all don't have access to MLS. That's it. If y'all had access to MLS, every one of you could do this, and it would take you half an hour. But you guys got to understand that Kingwood is its own market. It's not Houston. I live in Houston, but Kingwood's not Houston. Kingwood's 140. Okay. But when I break down Kingwood now, you see different subdivisions, different price. Does that make sense to you guys? I think that makes sense, right? That's really what I'm trying to say. Okay. So what I'm going to try to do now is, let's see if I can pull up, and we can do now our market analysis. Okay. Which is going to look like this. All right. MA stands for market analysis. This is all we got to do. We just do this on a scratch piece of paper. We can do this at a restaurant. This is so easy if you have access to MLS, which is this right here. Okay. So what I'm going to do first is, remember, you guys, I keep you in Kingwood. All right. And we're going to fill this out as we go along here. Okay. So I'm keeping you guys in Kingwood. So let's go to quick search. If you're a realtor, I'm telling you, this is like, you want to write everything I'm doing right now. Write this down, because this is how you help people. Okay. So first of all is, let's look at the active stuff in Kingwood. And I'm going to show you guys a home that is for sale for a pretty good deal. Now, remember, I've been looking for homes for $120 a square foot. Okay. But all I'm going to do is I'm going to pull up all active listings. I'm going to categorize those listings by price per square foot. And I see, oh my God, how's this house only $104 a square foot? So I want to look at this house at $104 a square foot. Okay. Now, this is a foreclosure. They're only accepting cash offers. So this is going to be really hard to get. But look at the condition. You guys have seen, this is a foreclosure. Look at the condition on this house. Oh my God. I may try to buy this house. I don't know. Please don't, mark down this address and harass me, but I may buy this house. It's a foreclosure. It's $104 a square foot. This is absolutely crazy, but let's do an analysis on this. Okay. So the first thing that I want to write down and I want to note is the subdivision, which is right here. Okay. So the subdivision, and I'm going to write that on the form now, is Kings Mill. Okay, so let me write Kings Mill, because we have to do a market analysis in the subject property subdivision, which is Kings Mill. We also have to write down the price, okay, the listing price, which is $346. I'm gonna write that down up here, $900. We also have to note the size of the house, which is big house. The bigger the house, usually the lower the price per square foot. Always remember that. Smaller the house, generally the higher the price per square foot. But the size of the house is a whopping 3,326 feet. Now, remember, I also want the taxes, because I have to figure out cash flow. So I'm just going to do the easy way here. And oh my gosh, the taxes, look at that. So that's the only thing. That's the hard part about this deal. The taxes are a whopping $12,105 a year. Now, if it's my primary residence, I'll be able to file a homestead and drastically reduce that. But that's a crazy, crazy, crazy amount of money. So this is what we have. Okay. You're probably like, oh my God, that you write horrible. Yes, I understand that. But we have pretty much filled out most of the stuff. And now what I need to do is I need to analyze the subdivision. I need to figure out what the average price was over the last year and what the average rent was over the last 1 year. Okay, so in order to do that, I come back here. And let me go back. I'm going to show you guys everything in Scratch. And please bear with me. I'm going to do the best I can to try to teach as many people as possible how this works. It is very easy, and it is also very important. So all I'm going to do is go down to the subdivision section right here, and I'm going to put in Kings Mill. Okay, because I only want to do an analysis on Kings Mill. Remember, it's hyperlocal. Okay, so I put Kings Mill right there. Is it 2 words? Is Kings Mill 2 words? I think it might be 2 words. Yeah, okay, so it's 2 words. Let me copy this. Okay, now I'm only going to look at the last year of homes that have sold. Okay, so 365 days. So the total amount of homes that have sold in Kings Mill over the last year are actually a surprising amount of 62. So 62 homes have sold in the last year in that subdivision. So what I'm going to do is I'm going to select all this data, and then I am going to hit tabular here, and it's going to automatically calculate the average price per square foot, which is right here. So the average price per square foot was you guys see the wedge? Can you already see the wedge, you guys? Can you already see the wedge? Okay, so the average is $144.11. Okay, so again, I've put that here. See that? So now I know $144.11. And remember, you guys, the property is listed at $104. That means there's how much? It was a 30% wedge? Oh my God, right? So anyways, let's go back into this right now. Okay, and what I'm going to do now is I'm going to go back here, and we got to calculate the rental, the cash flow. Okay, so I go down to rental, quick rental, same thing. I'm just going to do the same thing. Put the subdivision, which is Kings Mill right here. And I just want to see the last year. Now, again, if I'm serious about this, I'm doing 3 years, right? I'm going back to 2021. I use 2021. I'm in a market that has, it's different though than a lot of people. So let's look at the rental market. 27 homes have been rented out. I'm going to select all of the data and hit stats. And this is a general way to do this. You'll get more detailed the more serious you are. Okay, so we know that the price per square foot over the last year was $1 and a penny. So I'm going to put $1 and a penny right here. Okay, see that? This is getting really, really easy. Now, I'm going to calculate my mortgage payment. Okay, so let's do the mortgage payment right now. Let me come back here, and we're going to access Google. And we're just, because I am not representing you, okay, we're just going to type in mortgage payment calculator because it's literally that easy to do. And remember, check include taxes and insurance. We're going to put the home price right here, which is the $346,900. And then after that, we're going to just say it's 5% down. You guys can play with this. A loan officer should help you. So 5% down. And I'm going to increase the property taxes. Remember, we wrote down the property taxes, $12,105. You out of your mind in Texas? Like, what the heck? All right. So I now have an estimated payment. Again, this is an estimated payment. You'll want to talk to a loan officer. But my payment is now, I have that. So I'm going to write that down, $3,650. That's crazy, right? Look at it's because the interest rate. Let me show you guys what it would change to if the interest rate was 6%. We'll go from $3,650 to $3,300, $350 difference. That's wild. So anyways, guys, now we have the form completed. Let me switch like this. Whoops, like this. Sorry. So now that we have this completed, it's now simple math. And you guys should be able to see there's cash flow down there. That's all I need to calculate now cash flow and wedge at the most basic level. There's more things we could do, but at the most basic level. So all I have to do now is I multiply price by size. And then I subtract listing price, okay? So let me show you guys that. Let me see, can I pull up a calculator that you guys can see? Can you guys see that? Okay, so I'm taking the size of the house, 3,326 feet, times the average price, which is $144.11, gives me, wow, that gives me $479,309. So now I reduce that by the purchase price of $346,900, which gives me a whopping wedge of $132,000 and $132,409. So you guys, I'm going to say, yeah, that's a lot of wedge right there. So I would look at that. Now, if I want to do the rent, I take the rent and I multiply that by size as well. Okay, so I'm going to take the size of $3,326 multiplied by $1 and a penny a square foot, which gives me $3,359. So now I subtract that by my mortgage, which means, which gives me a negative cash flow, negative cash flow of $290.74. Okay, so when we analyze this foreclosure, what do we know? We know that there is wedge. We may want to look at this property a little bit more. And then we also know that, hey, maybe we want to put more money down, maybe, so that we could eventually get cash flow. And ways that you basically would be able to do that is better credit, more money down, smaller purchase price. But if you guys want to watch that again, please do. It will be chaptered in the description. But I mean, you guys, this is simple. This is simple math. Now, obviously, I'm doing a live video right now, so it's a little bit harder for me to do that. But I mean, we did a live right now. I showed you guys a property with $100,000 in wedge. It is a foreclosure. You got to get special financing for the foreclosure. But I mean, this is going on right now. I mean, it is going on right now. So let's go into our third video. And and then after our third video, we're going to finish this out. This next one is on existing home sales. So again, a little bit bullish. I hope you guys like it. I'm going to mark this real quick for you guys. We're almost done. I really hope that you guys learned. I'm really trying so hard to effectively teach. That's true legacy, in my opinion. But let's get this started. If you guys can, let me know about the audio. I'm going to look at the new home prices, see if it went up or down right now.
Believes the spring selling season will be very mixed. Not terrible, not great. And he says the jump in mortgage rates back above 7% has come at an inopportune time. Joining us now is Ryan McKevney. He's managing director at Zelman and Associates. Ryan, welcome. Good to have you here. Why is this an inopportune time for rates to be moving in the direction they're moving? Is it simply because, well, you don't want that at the start of a spring buying season?
Yeah, thank you, Tyler. It's nice to be here.
Real quick, guys. It's not positive, brother, because your rent is $3,300 and your mortgage is $3,600. So it can't be positive. You know what I mean? I appreciate you. I was like, oh my God, my math was wrong. And I will make mistakes from time to time, generally not, but it is not supposed to be positive. I mean, how could it be? Your rent is lower than your mortgage. You know what I mean? This guy's an absolute beast, by the way. I love you. Let's get back to this.
That's exactly the point. The movements in mortgage rates do matter a lot. I think your colleague Diana framed things nicely, which was the January existing home sale data that came out today. It was a good number. It was up from December. It was the best since August. When we look at the go forward trends, when we see what's happening real time, whether it's some of the survey work we do, whether it's the data we analyze, we have seen a bit of a slowdown in pending contracts in the month of January and into February. So while that headline for January was quite good, we do expect a bit of fading as we go into February and March. And at the end of the day, movements in mortgage rates going from 6.5 now up above 7, as you referenced, it does matter, and it's going to matter for that monthly cadence of transactions.
Because to just pinpoint it here, because the January numbers were based on closings that took place in that month on transactions that were probably initiated when mortgages had come off the boil a little bit, right?
That's exactly right. Mortgage rates hit up close to 8% in October, dropped down to about 6.5% in December. And that's when we saw the big push. We saw really nice pending home sale activity in December. That's what flowed through into the home sale number today. But again, as we moved into January and even more so in February, mortgage rates have moved back up. That has corresponded with a bit of a fading. And I would say 1 month doesn't make a trend. You know, we do want to see that momentum building into the spring selling season. It's when the most activity happens. But at the same time, if we have mortgage rates peak out here and move lower, we do think eventually that occurs. It's very dependent on the Fed, very dependent on inflation. Our view today is existing home sales for the full year of 24 will be up a few percent from 23. So moving in the right direction, not a V-shaped snapback, at least not this year. But we likely have hit the trough in the latter part of 2023.
Are you surprised at all that prices have continued to go up, even in the face of high interest rates? I suppose the reason for that is that inventory is still relatively low. So if you don't have supply, that creates a floor under prices and maybe makes them go up. But the basic question is, you might expect with high or rising interest rates that prices would be much more restrained than they are, and they have continued to show basically pretty healthy gains.
Yeah, Tyler, I would say in 2023, one of the strongest points of upside to all of the housing metrics we forecast was in fact home prices. It is the dynamic you referenced. We've seen very low levels of transactions, but we've also seen very constrained inventory levels. So you haven't seen the large mismatch between demand relative to that supply. And that has fueled ongoing strength in pricing. As Diana mentioned, affordability is very stretched. You have to go quite a ways back to see this level of affordability in a bad way, unfortunately. But price continues to move higher. As we think about things going forward, we do see inventory slowly starting to pick up. This month, it was up 3% year over year. We think it continues to build through the year. Eventually, all the buyers out there have a bit more to choose from. We think eventually that helps lessen the rate of price growth eventually. But in the moment today, prices remain strong and continue to move up.
Are there any anomalies in the housing market region by region that you can point us to? In other words, is South Florida still blazing hot and the upper Midwest still cool, or vice versa, whatever?
I would say there are a lot of market by market differences. Even within South Florida, some areas remain hot. Some have cooled down a bit. I would say most recently, the checks we've done around the country, the areas that stood out most positive to me were on the West Coast. Seattle, very strong. The Bay Area, very strong. I actually heard a guest of yours, the CEO of Compass, make a similar point today, and that's exactly what we're seeing as well. So areas of strength for the moment appear to be shifting out to the West Coast.
Interesting. All right, guys, I got some really good comments, for some consumer comments I'm going to address here in a second. Let's go now into our liquidity update real quick and recessionary indicators. This is where I'm going to pull up Case-Shiller as well and show you guys kind of the difference of the 70s and 80s. But let's go over here now and do this segment of the video. Liquidity segment, also recessionary indicator segment. The inversion is the same. I mean, we've been stuck in 30 to 40 basis points, it looks like, for a while here. We're still inverted, you guys. This is a huge warning sign of a recession. And for the people that said, oh, you've been talking about this, nothing has changed. Well, the inversion is a massive deal. Oh my God. Like, how do you not see it? But anyways, guys, we're 41 basis point inverted. And honestly, if we look at how long it takes for reversion, I mean, it's possible we don't even hit recession until the end of this year, quite frankly, but the reversion is still not there. We're not even any closer. We got close at the beginning of this year to an inverting or reversion, but it just didn't happen. Very, very interesting. So watch the 10-year treasury and the 2-year. That's called the inversion right there, this chart, the 10 and the 2. Now, after that, guys, let me talk about this, okay? Now, this is something I kind of just want to address what I was talking about earlier with Jeff. And basically what Jeff is saying, and he likes to compare, and there's a lot of other people, and I'm saying that this is one of the most logical kind of that bullish narratives that I believe exists. So one of the most, but his thing is the market may stay, and I don't want to put words in your mouth, Jeff. I'm just paraphrasing the best I can, but that the market is going to stay sideways long enough for wages to catch up. Right. And a lot of people like to compare that to what happened in the 70s and 80s, because home values went up in the 70s and 80s and sustained. They did not go down in the 70s and 80s. They went up. But again, the consumer was different. And so when we lay the CPI over the Case-Shiller home growth, CPI being the black line, CPI is kind of that gauge where we know what's going on with consumers, right? Consumers have the ability to save money, have the ability to, more importantly, spend money. So the CPI, it's not tracking consumers exactly, but it is a good way, in my opinion, to kind of see what was going on with consumers versus what was going on with the prices and the cost of houses. So when we go back here, you guys, basically pre-1990, you can see how there's not a big divergence there. The reason why during the 70s and 80s, there's not a big divergence between CPI and Case-Shiller is because back then we had double-digit wage growth for not quite double-digit every year, but I'm talking we had 7, 8, 9, and 10% wage growth every year on an average. Can you imagine a 10% wage growth in just 1 year for the average everyone in America? Can you think about that? I've lost 25%. I haven't gained 10%. And so not only do we have the wage growth during this time right here, you guys, if we look at the savings ability, the ability of people to save. People were saving during that time through recession, which, by the way, we haven't even entered yet. They were saving at double digits as well, 10, 11, 12, 13%. Right now, we're under 4, or we're right at 4. So not only do we have a lack of wage growth, we have a lack of the ability to save our money. And let's just throw in subscriptions, school loans, excessive spending, wage gap. Let's do all these things. And I'm just explaining, I'm not picking on anyone. I'm just explaining to you my view of things. This is just my opinion, the way I see it, because you see the divergence here. You see the divergence of home prices versus what the consumer is capable of. And quite frankly, America is not capable, is not capable of sustaining this level of price increase. The only way that America could become capable is we all make more money. That's the only way. I mean, how else are we going to do it? Well, I guess you can argue money printing, but I mean, you guys see my point there? And Jeff, I really appreciate you, man. It gives us an ability to talk about kind of both sides of the coin. And that's my point with, like, it's really hard to compare 70s and 80s to what's going on right now. It's just the consumer is just so much more beat up right now. Now, here's the reverse repo market. This is kind of like the suspension system, right? Danielle DiMartino came up with that term. I like it. This is the excess savings. We're now at 520 billion. Okay, that's still a lot. It's kind of been sideways for half of the month. And I'm hoping and I'm suspecting this is going to be gone by May. Once this money is gone, a lot of people are saying it's going to be a lot more rocky road. Things will break a lot faster. But because we have this cushion, the suspension system right here, the economy has remained resilient through quantitative tightening in some aspects. Here's the liabilities held, guys, from the Treasury General account. And to put it in perspective, this is where they're at, like pre-lockdowns, 200 to 300 billion. Right now, they have 785 billion. So plenty of money in the Treasury General account, depending on how they're spending, of course. But just, historically, they got a ton of money there still. And then we also look at this money here, which is even more money at 7 with a T trillion, $7.5 trillion held by the Fed. Okay. That's not good. That means that the Fed's in control. Pretty much everyone knows the Fed's in control. They got 7.5 billion. So if you don't think they can manipulate the markets, I don't see how you could say they couldn't when they have this much in assets, 7.5 trillion. I mean, let's just be realistic about that. Now, to put things in perspective, you guys, there's also a liquidity issue with the credit card spending habits. Now, what you're looking at here is the credit card debt. Okay, so credit card debt, 1 trillion with a T. But I want you guys to also understand that doesn't mean that everyone holds that balance. This is the information that's reported off people's bill. So I've read reports that approximately 44% of people pay the whole bill off. So reduce this hypothetically by 44%. And that's how many people are actually struggling in debt. Okay, so again, more than half of the people struggling in debt, but a little less than half are actually paying off their credit card. I wanted to make that clear because a lot of people aren't covering that really important part of tracking that data. Now, real quick, guys, also some more, good news for you. I think it's good news. If you guys want to empower yourself, remember, I am working on another community, another platform where everything is kind of centralized. It's just been extremely hard to do that with the lack of time. But if you guys want to go to my home buying course, it says teachable. I should just put free buying course right here. You just go to my main page on YouTube and just click this link right here and it will take you there. And hopefully that will help. I want to bring up some Q&As real quick. I'll try to be really, really fast, you guys. I know we're going along this morning. Hopefully you guys have a great Monday as well. And also I got a super chat. I believe Don't Move. I appreciate you, Don't Move. I really do, man. New sales month over month expected 0.9 increase is actual 0.66 increase. Also, we have the data out for new homes. Let me switch to new homes real quick because that data is out right now. Okay, so new homes. Okay, look at it. So it's at 413. Let me show you guys, and I appreciate your support. Don't move. I really do, man. Okay, it went up from 413 to 420. So this went up 1.7% month over month. It increased by $7,600 if they close. So that did go up. So to me, again, normally it goes down from December to January. To me, this tells us, guys, and I'm not trying to I'm not reversing my opinion, so calm down, right? I'm just reporting what I see. I still believe everything I said. I mean, my God. But this shows me that, yeah, home buying season came back early. It came back early this year. I've seen that in my own market. I don't, I still want more time, but again, we don't have generally we don't have in specific markets the type of price growth like this. So I think what we're seeing here, guys, is I think we're seeing just I think we're seeing a little bit of an increase in demand at the start of the year, which is abnormal. Normally, it's more of a spring thing. Let me pull up some stuff here real quick. All right, so we got a Q&A now. So what about deferred maintenance? Do you have to calculate the money needed to bring it up to serviceable condition? So what he's talking about, this is why I put this up here, is when I was doing that market analysis, I try to be clear that it was a rough market analysis and that if you were serious, you had to dig in a little bit more, because I did not include things like deferred maintenance or property management fees. So I gave you guys a way to determine how something would cash flow. But obviously you want to add maintenance potentially, and also vacancy. You want to put a little vacancy in there, property management and things like that. So that's what he was talking about there. I just wanted to make that point as well. Okay, so this is, it would be wise to wait to, would it be wise to wait to buy? 5 years from now, will the prices of homes drop or stay the same, or will the interest rates drop? Interest rates drop, how low do you think it will go? I would say that if there's not going to be a recession, if there's not going to be unhinged unemployment, then the economy has to make it through 2025. If the economy makes it 2025, the entire year, there's no recession, it's hard to not act like there's a soft landing. So I think that in 2025, we are going to have a spike in unemployment. And the reason I say that is one of the toughest years for commercial real estate. That is when the most amount of loans will be due. And as a result of the increased cost of these loans having to be refinanced, they're obviously going to there's going to be layoffs. And when layoffs happen, it's a domino effect. It's almost impossible to stop without massive injections of liquidity. So in I don't know. I mean, the thing is I don't know what's going to happen in 5 years from now. I don't even know what's going to happen 5 days from now. I mean, there's so much craziness. But what I will say is you need to know what's going on today in your market, and not only in your market, with yourself. If in 5 years from now, I go from a 600 credit score to an 800 credit score, my rate should be lower because my credit score is 200 points higher. So as far as when do I think interest rates are going to go down, I'm guessing towards the end of this year, because I believe they will only go down significantly because of recessionary an event, credit event, economic event. So I believe I think you're going to see that this year, but I don't know if it's going to happen this year. But I do not think we're going to have much lower interest rates absent some type of turmoil, because if we don't have that turmoil, demand will come back. So far, anyways, until that demand is exhausted, because again, 70% of the people are already priced out. So how do you bring the 70% of Americans that are priced out of the market? How do you bring 10%, say 10, 15% back in? How do you do that? It's complicated. So here's another comment right here. Travis, what was the biggest aha since you started representing clients again in the market? And here's the thing. I want to make it clear, David, I am not just representing people. I am representing a single probably I'll represent maybe one person at a time. And I do have the blessing of being able to turn my back on people that don't qualify, like are well qualified. So the people that I'm helping are well qualified buyers. They watch my channel. They have a realistic expectation. They understand the wedge, the cash flow, and they are cool with me saying, don't buy that. It's a piece of trash. And so I would say the biggest aha moment was what I noticed was, and it hit me by surprise, was just how busy some markets were already. That hit me by surprise. So when I was out showing houses, and not in every area, this is specifically Katy, in the $400,000 to $700,000 price point, I was really surprised by that. It was really busy. I was really surprised by that. I was oh my God, is home buying demand back early? It ended early last year. Is that why it's back early this year? I mean, everything is kind of flipped upside down on its head. Last comment right here. I looked at a house yesterday with $4,000 property tax. They had reduced the home, so the taxes would actually be around $10,000. So it just depends. If you're in Texas, they don't do it that way. So let me just say this, Carla. So the way to determine taxes is not the purchase price necessarily, depending on the state. It's the assessed value multiplied by the tax rate divided by 12. And that will get you your monthly taxes. So you got to go assessed value. And if it's too high, you can protest that depending on the state. multiplied by the tax rate. So if your assessed value is 100,000, your tax rate's 3.5%, your yearly taxes is $3,500. You divide that by 12, something like $300 and some dollars per month. Hope that explained that, you guys. That was a brutal live. I try to do maybe a little bit too much. I hope I trained you guys right. I try to be cheerful. I try to be effective in my training. I don't want to just talk about doom. I don't want to just talk about how bad the market is, even though it's bad, even though there's a lot of doom there. I also want to talk about what it takes to become a winner. What I believe, based on my experience, there's multiple people say multiple things, but I hope I'm training you guys. I hope by you guys being a part of the channel, being a part of the community, that it's helping you grow, that you have that you have better credit now, you have more money saved, you have a better understanding, you know what to watch for. That's my goal, you guys. So if that doesn't happen, I don't know if I can keep doing this. I need to know that you guys are leveling up. I mean, how cool of a job would it be? I'm helping people level up, right? I don't need to conquer the world. I don't need to make $1 million. I don't need to make $250,000. I don't need to make any of that. I just want a balanced life. I want to help some people. And I thank you for allowing me to do that. Now, I hope you guys have an absolutely great morning. Happy Monday. Have a great week. Love some people. Don't freak out and make the good news. Don't ask for it. Make it. And other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck. And I hope you win.